I mean, the OG selling is one of the biggest factors. Every single cycle, OGs sell. They usually, they got Bitcoin. It goes up depending on how OG they are, 10x, 20x, 100x more. It goes from, like 5% of the net worth to 95% of the net worth in some cases. And then some of them have families. Some of them want to consume more. Some of them want to diversify. They say, I don't want 95% of my net worth that's now substantial in one asset. I mean, now I can diversify in a couple other things. I can get real estate. I can get equities, whatever. And so you do see that selling pressure into bull markets, liquid, high price markets. And one of the narratives I've seen this time is that there's like an unusual amount of OG selling. Statistically, I push back on that because every cycle there's OG selling.
It's been a most interesting and vindicating couple of days for Bitcoin and crypto investors, particularly for Bitcoiners who predicted that Wall Street would bring nothing but brutal manipulations, price distortion, and dilution of fundamentals for the crypto and digital assets space. Though many other crypto investors scorned these critics back in 2023 before the ETFs, the critics may have just been proven right. If you've been active in the crypto space in the past 2 days, you've probably seen speculations about quantitative trading firm Jane Street Capital being heavily involved in the constant price manipulation that has seen Bitcoin taken beatdown after beatdown over the past few months. Jane Street was reportedly running an algorithm that dumped Bitcoin every single morning at 10 a.m., every day, for months on repeat, crashing the price, liquidating retail, and lowering sentiments to some of the lowest ever recorded in this space. The infamous Bitcoin 10 a.m. dump has in fact been talked about for months, and several entities, from Coinbase to Binance, BlackRock, Wintermute, and Jane Street, have been accused of being a part of a coordinated 10 a.m. attack to bring down Bitcoin prices and allow these entities to buy back at lower prices. This continued for months, until something happened earlier this week that not only stopped these coordinated dumps, but might also have confirmed speculation that Jane Street was heavily involved in the dumps. Jane Street was sued for insider trading and market manipulation earlier this week, and Bitcoin's reaction was instantaneous. With no 10 a.m. dump for the first time in months, Bitcoin moved sharply, rising by over 10% and adding over $120 billion to its market cap. Bitcoin's weekly candle also turned green after 5 consecutive red candles. Most importantly, the lawsuit alleges that Jane Street was behind the Terra Luna crash, which wiped out over $50 billion in valuation in just 3 days in May 2022. In today's video, we break down a chain of events that sound almost unbelievable, showing that Bitcoin has been in the crosshairs since at least 2022, and that OG Bitcoiners may have played a significant role in all of this. We will present arguments from Lyn Alden on the current state of the crypto market, the role of the OGs, and what lies ahead for Bitcoin. We will bring you a complete breakdown of how Jane Street has been manipulating Bitcoin, making tens of millions of dollars every single day. If this sounds interesting, sit back, relax, and watch to the very end. Smash the like button and subscribe to the channel for more videos like this. Thanks for the support, and let's dive right in.
I think we're moderately lower than where I would have guessed. I usually am on the record of kind of being like a bearish bull, which is I'm generally on the more conservative side of the price spectrum. I try not to even give too many price predictions. When I do, it's usually a pretty conservative one, and sometimes we undershoot even those. I mean, the first time I gave a price prediction was back in 2020. Bitcoin was in like the 10K range, and I said I think you could hit $1 trillion market cap, which at the time puts you around 50,000. We got to there, and I said, well, I think it can go to 100K, and then we only got to 69K for that cycle, rolled over, and then when kind of pushed into a quarter to give a price target, I would generally, for this cycle, I would say, well, anything under 150K would be kind of disappointing. And we only got to 126 so far. So I would, classify this much like last time as kind of a semi-disappointing cycle. And from what we can tell, I mean, most of it is just there's a kind of a lack of top line demand. So a lot of people kind of look for reasons, and we could potentially go over some of those reasons. But I think at the end of the day, the core one is this cycle just didn't attract a lot of individual hodlers, basically. Obviously, the ETFs unlocked some interest from people that have brokerage accounts and otherwise would like some Bitcoin access and just, kind of had limitations before. Obviously, the treasury companies were major buyers this cycle. But because we didn't really have sovereigns come in, which I think that expectation was too bullish, But then also we didn't really have a ton of retail come in. There's a ton of other things they can invest in, like AI related things. When Bitcoin gets big enough, it's not necessarily the fastest horse anymore. And so it relies on its other qualities, like the fact that you can self-custody it, that actually, it's not just a number on a screen like a stock. It is something that, more like physical gold, but in digital form that you can use, you can send, you can pay with. Um, and if those features go through a cycle of just not being of particular interest to people, so we didn't see a lot of Chinese buyers, we didn't see a lot of American buyers, we didn't, it just kind of, I would say it stagnated this cycle. And I think a broader issue, um, is that one, there were some misaligned expectations early on. So, for example, Bitcoin slightly overperformed my expectations in 2024. I was actually on a panel in the New York Stock Exchange, and like Michael Green was hosting it. Nick Carter was on the panel. I was on the panel. Eric from Bloomberg was on the panel, and they were saying, could Bitcoin hit 100K this year? And I said, well, I mean, Bitcoin can do a lot. Bitcoin has, these moments where it does crazy things. I was like, we only had a few months to go. So it's like, it wouldn't be my base case. I think we were at like 60K at the time or something. So I'm not going to call for a price move that big that quickly, but I wouldn't be shocked. But because of the election, we did. We kind of pulled forward quite a bit of demand because we had this new information, an administration that's going to be supposedly more friendly to the asset. Um, but then in early 2025, the biggest question I got on podcasts for a while was, what do you think about a sovereign Bitcoin reserve? And my view was, I think they'll ring fence the coins they have, maybe buy some, but I wouldn't, all the kind of calls for 500,000 coins or 1,000,000 coins. Uh, I'd rather not price that into my expectations. I'd rather be surprised to the upside. But I think a lot of people did kind of have that expectation. So when you didn't really see the U.S. or other sovereigns come in, uh, and you didn't see like just influx. I think people had kind of over enthused expectations. And for me, even though it undershot the expectation, it's mainly just because retail didn't come in this cycle.
Where do you stand with this? Are you still kind of in a wait and see period where you're saying, okay, yeah, we could have some significant drawdown from here? Or do you think most of the kind of sell pressure has been exhausted at this point?
The short answer, I'm still in a wait and see mode. I look for some sort of price confirmation before trying to make a bottom call. We started to see a limited one like in December, January. So for a while, I was like, okay, we had a sell off in November. We started to kind of hold, the momentum started to kind of build again. And I was like, there's a good chance this was the bottom. But then, of course, January came and we had that waterfall lower. So that kind of reset the board for like the next few months. Um, and historically, Bitcoin does not make V-shaped bottoms. The exception kind of was spring of 2020 when just hyper stimulus made a lot of things look like a V-shaped bottom. But usually because Bitcoin is not a stock, it doesn't have like an earnings announcement where they can like come out and surprise you the upside and just every analyst has to update their model and Wall Street buys. Instead, it only really bottoms when kind of fast money weekly held coins over time rotate enough into strongly held hands, and then it creates that that supply squeeze basically. Like there's just it becomes very tight. So it only takes kind of like just selling gets exhausted. It only takes a tiny new spark of buyers to restart the cycle, and then obviously a rising price gets new buyers on board. It kind of momentum creates its own cycle, and that because of that kind of lack of catalyst, unless some Mag 7 stock or a sovereign just decides to ape into it, it usually has that more gradual bottom. So the short answer is I don't know if this is the bottom or if we have like another waterfall lower. I would say that the sentiment is lower than other bear markets I've seen. It's I mean in November 2022, literally when FTX was like collapsing and the price was in the teens, I was at Pacific Bitcoin. I think you were there? You were there,
Yeah,
right?
yeah.
All the conversations kind of
Great
merged in my
time.
head. Yeah, it was great. The energy was high, wasn't it? Super high. I was joking on stage like FTX is collapsing and look how happy people are here because if you don't own crypto, if you're not kind of levered, then everyone was quite convinced, and correctly so, that this was just a temporary, part of the cycle. What I'm seeing this time is there's more kind of exhaustion, I think. I think after two kind of weak cycles, a lot of even longer term holders are a little bit tired, you could say. I think it kind of I think biggest risk people perceive is that it kind of ran out of like near-term catalysts, right? So it's like there's always kind of another big thing to look for, like say the ETFs coming out, the spot ETFs and things like that. They're going to unlock new demand. And at this point, they're like, okay, we've unlocked all the frictions, and it just comes down to whether people want to buy the asset or not. I think if anything, the joke is we need more podcasts, but I think that's actually true in the sense that the tools are built, the system works. Devs are still, both on the foundational layer, but also all the companies and stuff building out the broader ecosystem. A lot of that is in really good place. But people got to want to use it. They have to know the benefits of it, see that it's available, know how to use it, not be turned off by the complexity of it, or perceive that the culture about it is something that is just other than them, that it's only hardcore libertarians like it, and otherwise it's not for me. Like whatever the branding issue is or the technical complexity issue, I think that's actually the bottleneck.
Next, Lyn Alden addresses the issue of Bitcoin OG selling, which has always been a concern during bull markets, but has seemingly been more pronounced this cycle. For instance, in November 2025, OG Bitcoin whale Owen Gunden sold his stack of 11,000 Bitcoin worth $1.3 billion. This Glassnode chart from November 2025 also shows how active Bitcoin whales were in 2025, with orange lines indicating $100 million dumps and red lines indicating $500 million dumps. The chart also shows how much busier the whales were in 2025 compared to previous bull markets. So, yes, there was manipulation, but before we point fingers at Jane Street and the rest of Wall Street, we need to really look at what's happening within the crypto community. Let's get back to Alden's analysis.
I think the OG selling is one of the biggest factors. So I guess the two biggest factors are basically top line demand from all sources, whether it's retail, whether it's retail owning through shares in an ETF or a corporation, institutions buying into those shares and stuff. So all that kind of institutional retail demand, that top line demand, that's probably the single biggest factor. And then as the price goes up, every single cycle OGs sell. They usually, they got Bitcoin, it goes up depending on how OG they are, 10x, 20x, 100x more. It goes from, like 5% of the net worth to 95% of the net worth in some cases. And then some of them have families, some of them want to consume more, some of them want to diversify. They say, I don't want 95% of my net worth that's now substantial in one asset. I mean, now I can diversify in a couple other things. I can get real estate, I can get equities, whatever. And so you do see that selling pressure into bull markets, liquid, high price markets. And one of the narratives I've seen this time is that there's like an unusual amount of OG selling. Statistically, I push back on that because every cycle there's OG selling. It happens every single bull cycle. For example, and it depends on how you measure it, but like the number of coins that haven't, haven't moved on chain for a year, and then that metric, that's not been a particularly strong change of hands this time compared to past cycles. Currently, we're near all-time highs for the percentage of coins that haven't moved in 5 years or more. So you do get these individual massive whale sellers and just the broader, just kind of shark level sellers around, but that happens every cycle. And then also, because Bitcoin it's not a 5-year-old asset or a 10-year-old asset anymore, it's a 17-year-old asset. Kind of the spectrum of buyers that even count as OG at this point is bigger. There's just more people that have been holding for 5+ years, call it a cycle or two at least, that can then sell into that. So you can actually have more OG sellers, like in terms of the number of sellers, the number of Bitcoin they're selling, and yet as a percentage of older coins is actually not really elevated. So statistically, I don't really like kind of the bearish narratives where like OGs are becoming disillusioned in it or something. There's actually really statistically no evidence of that. I mean, there's always an anecdote like this whale sold for this reason, sure. But statistically, this hasn't really been an unusual selling environment for OGs. So I think OG selling pressure is kind of what exhausts the cycle every time, which is that there's new demand, there's price euphoria, there's OG sellers, and eventually that gets exhausted on the buy side, and then the reverse happens on the bottom in the sell side. And so I think OG selling was a key factor this time, but I think the reason we only got to say 126 rather than having that kind of peak out at say 150 or 200, I think was just because top line demand was on the weaker side.
So you don't think OG selling is driven by quantum's imminent cracking of Bitcoin?
I do not. I think the two there's a and there's more data we can look into in this. So, for example, if the thesis was true that that was the single biggest thing, as some analysts are saying, like if that was the single biggest factor this cycle, then in theory, you should see that more centralized altcoins that have a clear quantum roadmap because they're centralized, they can do that, or ones that are already semi-quantum resilient, they should be getting a very large bid, right? If that was like the key reason, then you should see pretty big differentiation between the most decentralized one that has a pretty tough time getting quantum resilient, which is Bitcoin, and tight block space, which of course limits quantum resilient signature sizes, and there's all sorts of complexities if we ever want to make this quantum resilient, versus ones that are in a better position because of their centralization and other factors to become more quantum resilient. We haven't really seen that performance gap. So I think now on the other hand, where I give that some credit is that I have it on good authority from very high level institutions that was a factor in some buying decisions by large pools of capital, which is any institution comes in, they say, okay, there's a bear case, a base case, and a bull case for what Bitcoin can do. And on the bear case, they have catalysts like what if the US bans it? What if quantum breaks it? They have all the FUD. Then on the bull case, they have what if, sovereign, whatever, base case, it is what it is. Now, if they get a little spooked by the quantum side, it kind of fattens their bear case to some extent. So they say they might have put in 5%, they put in 3%. They might have had a price target averaging 200K, and they say, well, because of this left tail risk that we have trouble quantifying, we're going to bring that down to 150K. And so, for example, one major institution said that basically, people went from like 5% of institutions were asking about quantum risk to 30%. And that was given to me before the peak. So I would guess that number for them probably got to 40 or 50%. So I do think that was a non-trivial variable in we call it kind of smart capital that would actually, knows how to ask these things. But I don't think that was like the factor. I think it was just a factor among many.
Now, back to Jane Street and crypto's 2022 crash. In May 2022, the Terra Luna collapse erased roughly $40 billion in value almost overnight after UST lost its peg. According to the lawsuit filings, Terraform Labs quietly removed liquidity from a key pool, and within minutes, wallets allegedly linked to Jane Street executed massive withdrawals of their own. The complaint claims those trades allowed the firm to avoid hundreds of millions in losses, transactions prosecutors argue would have been impossible without privileged information. That single event didn't just destroy Terra, it triggered a domino effect that helped take down Three Arrows Capital, destabilized lending platforms, and ultimately accelerated the broader crypto bear market that sent Bitcoin crashing toward $15,000. Fast forward 2 years, and Wall Street re-enters the story. This time not as an outsider, but as infrastructure. BlackRock files for a spot Bitcoin ETF. Institutional sentiment flips almost instantly. Bitcoin rallies from the mid-$20,000 range to new all-time highs following ETF approval in early 2024. And at the center of that ecosystem sits a critical but rarely discussed role, the market maker. Authorized participants like Jane Street facilitate liquidity, share creation, and redemption for BlackRock's IBIT ETF. In simple terms, they help control how capital flows between traditional finance and Bitcoin itself. That position provides enormous visibility into order flow, liquidity conditions, and market structure. Advantages that, while legal in traditional markets, introduce entirely new dynamics into an asset originally designed to operate outside centralized financial influence. Then comes the pattern that traders couldn't ignore. Beginning in late 2024, Bitcoin experienced repeated mechanical sell-offs almost every trading day at exactly 10 a.m. Eastern, right as U.S. market liquidity opened. The moves were sharp, algorithmic, and disproportionately effective at triggering leveraged liquidations. Long positions were wiped out, cascades followed, and price often recovered shortly afterward. On-chain analysts tracked the phenomenon for months, noting how consistent the timing was compared to normal market behavior. Whether coincidence, strategy, or simply aggressive liquidity provision, the effect was the same. Volatility increased, retail confidence eroded, and Bitcoin repeatedly reset lower before recovering. And then, almost immediately after the insider trading lawsuit became public, the pattern stopped. No coordinated 10 a.m. drop. No sudden liquidation cascade. Instead, crypto markets added roughly $170 billion in value in a single day. Bitcoin surged, Ethereum and Solana posted double-digit gains, and sentiment shifted overnight. Correlation does not prove causation, and it's important to emphasize that the allegations remain unproven and heavily contested. Jane Street has called the claims baseless. But markets don't move on verdicts alone. They move on narratives, incentives, and shifting expectations about who holds power inside the system. What this episode ultimately highlights is a deeper transformation underway in Bitcoin itself. The real question is whether Bitcoin can maintain its original promise of neutrality and transparency as it becomes absorbed into the machinery of global finance. Because if the same entities appear near both major crashes and major recoveries, investors are forced to ask whether volatility is merely chaos, or part of a cycle engineered through liquidity itself. And as Lyn Alden's analysis suggests, the answer may be more complicated than blaming Wall Street alone. Bitcoin's future will likely be defined by the interaction between institutional capital and long-term holders, between algorithmic liquidity and conviction-driven ownership. The next phase of this market won't just depend on adoption or regulation, but on who ultimately controls price discovery. If you found this breakdown valuable, make sure to like the video and subscribe to the channel for deeper analysis on Bitcoin, macro markets, and the forces shaping this cycle behind the scenes. Thanks for watching.